deficit. It started on the path for fiscal consolidation, and the numbers were credible. The tax revenue numbers which were assumed for next year are credible, and they're completely achievable. So there was not too much of any kind of an eyewash out there. The capex thrust, for which this government's budgets have been known for the last couple of years, that continued. In fact, the 7.5 lakh crore outlay of last year went up to 10 lakh crores. That's the headline number, and therefore this is very much an investment-oriented budget. Even on consumption, where not much was expected, we had some tax tweaks for the middle class, and while it's debatable how much of it will actually come through because of how many people will eventually switch from the old tax regime to the new tax payment income tax regime, it still was something marginally positive. The dreaded capital gains tax on equities did not come about, and that was a huge sigh of relief for the stock market as well. All in all, it was not a bad budget, and one would have thought, and for a minute or for many minutes it appeared that the stock market was going to thump the table on this budget, because the Sensex was up 1400 points, the Nifty did very well, and then came the rout in the Adani Group stocks, and by the end it was a down day. But all in all, we've got lots to talk about over the next couple of hours, and we can start off with, I mean, you'll hear many big voices on the show, but I'm going to start off with Subhash Chandra Garg, Dr. Sanjaya Baru, and Madhu Kela to talk about the macro and about the financial market aspects of it. Gentlemen, thank you very much for joining in. Madhu, first word to you, because as I said in my preface that it was a budget which deserved more from the financial markets, but the Adani Group accident came in the way. How do you read what's going on out there with this group, and how much of an influence it's having on financial market sentiment overall?
Udayan, first of all, thank you so much for having me. I always have enjoyed discussing budget with you over the years. So thank you so much for having me again. I think it was a very good budget, Udayan, as you were summarizing. The finance minister actually met all expectation. I would say I would go to the extent of saying that she actually surpassed expectation in some aspects, specifically when it came to capital expenditure. Even the most optimistic people were not expecting that the government will actually spend 10 lakh crore rupees on the capital expenditure side. So I would say, all in all, it is a very good budget. I think these other events, Udayan, in my life of 32 years of stock market career, a lot of these kind of events have come and gone. But the people who have actually had a real faith on the overall India story are the ones who have actually made money in the stock markets. So for all we know, even after such a great budget, you might be getting a lot of stocks in a very attractive manner because of what is going on and because of the turmoil which is going on. So a person like me, I am more focused on all of this, what I want to buy, and at what value do I want to buy. And I'm sure as the time passes, these things will settle down. And I would just want to make one comment. The people are going just too far-fetched when, there is a talk already that, what will happen to public sector banks. In my opinion, nothing is going to happen to public sector banks. They have gone through a very, very tough credit cycle, and forget lending to Adani Group. Whoever they are lending, at least we are in the market, they are very careful, and I would say even the borrower today is very careful. So because of this turmoil, if you are getting stocks very cheap, then we have to just focus on buying them.
Well, you're right, Madhu, because State Bank of India was down 10% at one point today, and that was a reflection of how worried investors are about what ramifications the Adani Group crisis could have on public sector banks. But Mr. Garg, let me come to you, because you studied these investment or capex outlay numbers very closely. What did you make of that 10 lakh crore figure, and how much of it might actually trickle down in terms of real implementation and galvanize the credit cycle and the capex cycle to the extent that the government is seeking to do?
So thank you, Udayan. I think the 2 points you made about the the credibility of the numbers and the fiscal maths, I think that is quite welcome and credible in my judgment as well. But when you go a little deeper into it, and I'll address your question on the capex, so it looks very good when the revenue expenditure is substituted by the capital expenditure, which is considered to be productive and investing in the future of the country. But let me sort of take you through these numbers. So the revised capital expenditure number is 7.3 lakh crores. And the capex number for the next year is 10 lakh crores. So there is a increase of about 2.7 lakh crores. Now, this comes from 5 basic changes. Number one, there is a change in the loans to the states, which is about 60,000 crores. So that is one item, which is not the central government's capex, but it is the state government's capex. And there it substitutes the state government's own borrowings and all. So it's not additional capex in that sense. The remaining 1.7 lakh crore of the capex is basically in 4 entities of the government. One is the railways, which has got 80,000 crore extra. Then you have the highways, which have got 40,000 crores extra. Then third one, you have the oil marketing companies, which surprisingly receives 30,000 crores extra as kind of some sort of marketing support. And lastly, there is an increase of 20,000 crores for the BSNL. This all 4 adds up exactly to 1.7 lakh crores. Now, if you look into this, the 2 entities of these, NHAI and the BSNL, until last year, used to borrow from the market to do their capex. Now, they have borrowed so much, or their credibility is so low, that they are no longer accessing the market, and that is substituted by the government of India's budgetary support to them in the form of equity. So it gives you a little bit of a jitter that our institutions, which were capable of raising capital resources on their own, are not able to do it. This year, the railway capex, which is 80,000 crores extra, of that 35,000 crores extra is being substituted for the IRFC's bond, which they used to raise in the market. So from next year, the IRFC is not supposed to raise anything from the market, and the government will provide 35,000 crores of support in substitution of the IRFC. Now, IRFC has been a very credible market player and used to raise all these resources. And if IRFC is also getting into that mode where it's not able to access the market resources, then it gives me quite a little bit of worry. And lastly, the marketing support in the form of equity to oil marketing companies is certainly not a kind of real capex. So these 1.7 lakh crores of the government of India substituted entities and 60,000 crores to the state governments adds up to the 2.3 lakh crores of extra.
Mr. Garg, hold that thought, because you've raised a very pertinent issue, and I'm going to toss it to Dr. Baru immediately. Dr. Baru, the headline number of 10 lakh crores enthuses the market a lot, but what Mr. Garg is saying is that if you look at the fine print, maybe all of that is not real capex in that sense, some of it is substitutions, and therefore the net impact on the investment cycle will not be that salutary. Do you buy that?
You see, Udayan, the first thing what one has to recognize is the fact that, the finance minister said in a budget speech of February 2022 that the government is stepping in with public investment in the hope of kicking in private investment. Because we have had what I have described in my writings as a capital strike. We all know about labor strike, where workers don't work. We have had a capital strike in this country where business has not been investing. Private corporate investment has not been picking up. So the whole strategy as announced in the February 2022 budget was to use public investment to kick in private investment. And if you look at the increase in public expenditure as given in the revised estimates in this budget, a large part has been in revenue expenditure and some of it has been capital expenditure. So the question to be asked is, why is the private sector not adequately enthusiastic? Now, even like Mr. Garg is the best person to talk about the credibility of these numbers. So I'm not going to question him on his analysis of the numbers. Take it that he has a good understanding of these numbers. He's been on the other side of budget making. But the point is, for a whole year, we have not seen an increase in capex. I remember in the past on budget day, media would immediately look at the reaction of the stock market to tell us. I mean, I was for some time in government to say that, look, the markets have done thumbs down or thumbs up to the budget. And today we are being told the markets have nothing to do with the budget. The market reaction is about Adani and not about the budget. I think the markets understand something. And I think the understanding is that what has been done is not adequate.
Okay. Okay, Dr. Baru, let me get a person from the market and industry.
Don't interrupt me like this. When you get me on a show, listen to what I'm saying.
Finish off.
That's why I don't come on television these days.
Okay.
So I think there is a question about the credibility of these numbers, and there are questions in the market is raising. And therefore, we have to wait and watch whether private investment will pick up. Now, public investment is in the hands of the government. They have sustained a 6% fiscal deficit for 3 years. This again, used to be a mantra in the past. Anything above 3.5%, all of us in the media used to criticize the government. Today, 6% of fiscal deficit, is par for the course. So the government is doing its bit, trying to spend. But the real question for Indian economy today is the private sector ready to come and increase investment without demand picking up? Last 3 years, rate of growth has been 3%. 3% average annual GDP growth in the last 3 years. Now you go ahead.
Okay. Madhu, respond to this. This is really a point because, even banker after banker is telling us that private sector capex is not what it used to be in the go-go years of 2004 to 2007. Despite all the inducements and the crowding in effort which the government is purportedly doing, what is holding back private investment? Because we do need private sector to kick in for a proper investment cycle, right? Madhu?
Yeah. Hello, Udayan.
That was for you. Why is private sector not investing despite all that the government is doing? The point Dr. Baru is raising.
Udayan, I think first of all, we need to look in a historical perspective, the quality of private investment which went in between 2005 and 2015, and you have seen the repercussion of that. There's such large amount of NPLs which happened. I gave you this number last time when we were discussing 17 lakh crore rupees of aggregate provision between private and public sector banks were being undertaken in the last 3-4 years to clean up the whole banking system. So it is not actually apple to apple comparison if you take it from the past to what is happening today. That is point number one. Second, point number two, within people who we are speaking to, and there is clearly a green shoot in the private sector investment side. The corporate balance sheets are deleveraged, and I'm quite hopeful that the private investment side will pick up in due course of time. So and on the capex point, while we need to go and analyze these numbers more, but even if you take away some numbers which will be duplicate, still I think the government has delivered on the capex side more than what the market was expecting.
Dr. Baru, you raised the point of the fiscal deficit, but they've made a start towards that 4.5% number by saying it will go down to 5.9% next year.
Can I just come in on this fiscal deficit number 1 minute? Can I just come in 1 minute?
Okay, quickly, Madhu.
We have to also recognize that the old fiscal deficit which was being shown had a lot of hidden items. You had huge amount of oil subsidy, you had money which was recoverable from FCI, you had money recoverable from NHI. So there were a lot of off-balance sheet items which was all completely cleaned up last year, and there was nothing hidden. And that is why actually even the fiscal deficit number looks higher than what actually it should have been if I compare apple to apple.
Fair enough, fair point. Dr. Badu, you've been on the other side as well. You've been close to Dr. Manmohan Singh. I want to ask you about disinvestment, because that's a figure which the government falls consistently short of. This year too, they have put up a weak number at 60,000 crores, and no one is hopeful that that will be achieved. Are you disappointed that at a time when this money could have been so handy that they're dragging their feet on it and not able to even get half of what they're promising every year?
Well, I think it raises a larger philosophical question about the approach of this government, which is essentially looking at government doing more for the economy rather than the private sector doing more for the economy. I don't think they see adequate appetite in the domestic private sector for many of these shares. I mean, you saw how difficult it was for them to sell Air India. And the Tata board, in fact, did not want to buy Air India, but finally, I think the political pressure was brought and Tata's finally took over Air India. But it's not been easy because there is not adequate appetite. Now, you can, of course, privatize these public sector companies by allowing foreign investment to come. But their ideology blocks this government because the Swadeshi, Jagran Manch and various outfits of the BJP are opposed to private foreign investment coming and taking over the public sector. So I think the government's approach has changed. It's not about, whether there is not enough, appetite in the government for disinvestment. I think their whole approach is now that they see public investment as a driver of growth. And more money is being put in the public sector in the hope that at some point this will stimulate the animal spirits of private enterprise.
Well, this is quite different from what it started off with the statement that government is not in the business of business and government will become minimum and private sector will be allowed to participate or encouraged to participate. But today we are singing a different tune. Mr. Garg, Dr. Badu raised the point about the fiscal deficit. We spoke earlier in the day where you seemed a bit skeptical that we'll get to anywhere close to 4.5% in a couple of years' time. But after examining the numbers, what do you make of the quality of the fiscal deficit projection and whether we can get to 4.5 in FY26?
So we are at 6% today. That is credible. There is not much, or there is nothing off budget which is outside the budget. So let us take 6% as the credible. But you look at the adjustment we have done in last 3 years. So we were at 6.7% 2 years back. And in 3 years, we have come to only about 6%. So in 3 years, we have made adjustment of only 0.7%. Now, this in a situation where your nominal GDP had actually grown very high. In 1 year, it was 19%. In another year, it was 15%. If with that kind of nominal GDP growth, if you have this kind of adjustment, then hoping that the remaining 1.5% adjustment in the next 2 years would be possible is then quite, one has to be quite skeptical about it. So that is where I don't see there is any sort of seriousness. The most evidence of the seriousness was when the government had amended in 2018 the Fiscal Responsibility and Budget Management Act to say that the fiscal deficit would be brought to 3% by 2021 and will not be exceeded thereafter. And the debt would also be brought to about 40% of GDP for the central government. Now, when you had a statutory obligation to do it, the whole thing was junked. Now you only have word that we will bring it to 4.5% in 2 years with this kind of situation where GDP, nominal GDP is likely to sort of slacken now. I don't think that is going to be credible. Second, I think the minimum bar that 4.5% is what our most ambitious consolidation is going to be is also quite worrying to me. 6% of GDP adds about 18 to 18 lakh crores to your debt. It's every year now, interest servicing burden is going by 1.5 lakh crores. This is the entire increase in the expenditure, which is virtually being taken care of. On a 50% of the increase in the expenditure is being taken care of only by the interest. We should be deeply worried. So I don't think this we have a good fiscal consolidation strategy in place.
Point taken, Mr. Garg. Point very well taken. Madhu, quickly, can you tell me what this whole Adani Group episode, which was center stage today once again, is doing for public sentiment? Because, you know, we used to rely heavily on FII flows. They have disappointed in the previous year, but local investors have stepped up to the plate. But local investors are now watching all this every day, that, you know, we've started underperforming other markets. This Adani Group is punching them every day with this continued rout. Do you think it could derail market sentiment considerably if they stop buying too, shaken by this episode, and they cannot pick up the slack which is being left by FIIs?
Udayan, so there are 2-3 points. Of course, one should not deny that it has impacted sentiments significantly in the last 1 week. The second point is how much of ownership of FIIs is there in these groups. So, and how much would have got absorbed? I was just looking at number. On an average, a lot of these companies have corrected 50 to 60% in the last week, 10 days, you know, on an average. So I would say it issue should be a non-issue from a stock market perspective and from a sentiment perspective, and I will validate this. See, Udayan, you have seen more markets than me, right? If the market was really worried, how can so many good companies be in a green today? You know, ICICI Bank was in a green, Reliance Industries was in a green, Axis Bank finally was in a green. There were so many companies which actually were in a green and did outperform. So I think the pressure is only on this specific group and also on public sector bank, which I said in my opening remark. To me, it looks very far-fetched that because of this group, these banks are going to be having problem. I think it is too early to predict all that.
Fair enough. Gentlemen, thank you for your views. We'll take a quick break and come back with many other experts. Keep watching. This is India Today and Business Today's special evening coverage of the Union Budget. We are back in a few minutes.
The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team.
It's 2023, and India remains the sole shining star in the global economy. So what lies ahead as the Modi government prepares its last full budget before the 2024 general elections? Join the biggest names in business journalism, decoding the jargon with the biggest newsmakers. From the most credible, in-depth analysis of Budget 2023, tune in for Modinomics 2023 through the month. Only on India Today and Business Today Television, gold standard of business journalism.
The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team. Only on India Today. The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team.
It's 2023, and India remains the sole shining star in the global economy. So what lies ahead as the Modi government prepares its last full budget before the 2024 general elections? Join the biggest names in business journalism, decoding the jargon with the biggest newsmakers. From the most credible, in-depth analysis of Budget 2023, tune in for Modinomics 2023. Of business journalism.
The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that...
The budget before the break, we've been talking about the huge capex outlay and how much of it actually will be implemented and re-galvanize India's credit cycle and investment cycle. Views diverge on what kind of impact it will have and whether it can suck in and draw in private sector capex, which is what we need. Last year's evidence was not great on that front. And we have also been discussing the other events during the afternoon, which sort of derailed the budget from a financial market perspective because it took over from the initial positive reaction from the budget and made it something else altogether. That was, of course, the furor over the Adani Group stocks once again. And, of course, the looming FOMC meeting, which a lot of people believe may even be far more important than our budget in shaping sentiment for corporates and for stock market investors. Punita Kumar Sinha is a great person to talk to about all of these issues, as is Dinesh Kanabar, who joins in to talk about the tax angle, and very soon Vijay Kedia also will talk about the Adani Group episode. But Punita, let me start with you. But do you agree with the assertion that tonight's FOMC meeting will be as important, if not more important, in shaping sentiment and the direction of financial markets more than today's budget itself?
Well, I think it's going to be very important. If the budget had come up with a lot of negative surprises, then the budget would have also been quite important in terms of determining India's growth trajectory. But the budget has not delivered any negative surprises. So in light of that, I think the next big event is the FOMC meeting. And that is very important because it's going to set the trend for the global markets. And if the global flows get impacted negatively, obviously India will also be impacted negatively. So I think, in my mind, yes, the global investors are as important as domestic investors to the Indian markets, and to the extent that the global investors are watching the FOMC as closely as the Indian investors are watching the budget, both events were equally important.
Well, tomorrow morning when we wake up, Punita, we'll have both the result of the FOMC meeting and we would have the hangover of the Adani episode rout today. What would you summarize as global sentiment towards India at this point in time? Because FIIs have been selling India for largely for the most part of last year. Now these two factors, continued higher interest rates in the West, plus this Adani group which episode which has exploded over the last few days, what is the combined impact of these two on sentiment towards India?
Well, first of all, we have to look at short-term sentiment and longer-term, sentiment. And so let me take the longer term first, because I'm on a number of global boards where they are looking to India, and not just my companies, but a lot of other companies have the same thought process, as a very important market, both for demand growth as well as for outsourcing. And then also in terms of getting more supply and adding it as China plus one. So every US company is looking at India for its future growth. So from a longer term perspective, the companies itself and the strategic investors are going to keep investing in India, as if they get good valuations. I think they'll definitely keep coming because they don't have an alternative. Now, if you look at the short-term sentiment towards India is not that it's negative, but everybody's unanimously of the view that the valuations in India are not as attractive as they are in some of the other emerging markets. Emerging markets as an asset class is looking attractive after a long time to begin with in terms of valuations, and the China reopening story has been an important trigger. And the China valuations are actually so low as compared to India valuations. So while investors, strategics, etc., may not have the same confidence in the longer term stability of the Chinese markets and the regime there and what that might mean for them to invest for the long term, they definitely think that given the valuations where they are today, this is a place to reallocate some money or incremental flows. So they're going to keep doing that, and not just China, some of the other Asian markets, LATAM, Middle East. There are lots of other emerging markets that are attractively valued. And India does trade at a premium to its own historic valuations versus other emerging markets and other developed markets. So I think if there's a correction in India and the valuations again rationalize to more normal levels, investors will come back to India mainly for the long-term stability that the country offers.
Okay. Vijay Keti has joined in now. Vijay, the budget was supposed to be the main story of the day, but in the afternoon it got sidelined completely, overshadowed by the Adani stocks once again. Where is that story headed? How much more pain is ahead, you think?
Hi, Udayan. It is very difficult for me to say that when this pain will end. But one thing I can say that it is not going to end very soon. It will take some time, or maybe a lot of time. And my only worry is that it should not spill over to some other stocks and to the market. So that is the main thing. That is the main worry.
You know, the question which a lot of people ask to stock pickers like you is that, why have you not invested in Adani Group stocks? Have you in your career, or would you consider buying it now, or are there good reasons why you have stayed away?
I have never invested in any of the Adani Group shares. And
Why?
for the simple matter, it's not that I don't have the trust in the management and all, but for the simple matter that I always found the valuation very high. And I usually don't, always, not usually, generally, most of the time I invest only in low valuation shares and mid cap and a small cap and all. I always found the valuation very, very high. So I never invested, nor do I intend to invest even now also. Because now also I think valuation wise, they are very expensive.
You spoke about it spilling over to other sectors and stocks. What did you have in mind?
Sorry?
You just said that it should not spill over into other sectors and stocks in the market. What did you have in mind?
No, maybe I am too immature to say that, but maybe like the banks, the way banks are behaving, the way you State Bank is behaving, the way Canara Bank is behaving. So I don't know if suppose I don't know how much state, and when all these bankers, they come on the TV and when they give explanation without asking that we are safe, we are this and that, that makes me more worried. So so that is why all this State Bank and other LIC and all. So it's a matter of sentiment, Udayan. Who वो पहला पत्थर कौन मारता है, वो वाला बात है. It's a matter of sentiment. So let's see.
No, it is indeed a matter of sentiment. And I want to get, we will talk more about all of this. And Punita, this is what I was asking you. Has this spoiled sentiment in a sense? Because, today there was this note from Credit Suisse saying that we are not going to use or accept Adani loans or Adani bonds as collateral. And that sent the cat among the pigeons once again. Is it creating any kind of a flutter in the global investment community? If only in terms of sentiment.
It is. I think definitely for two reasons. One, it's, the worry about the biggest sector in India right now that people are quite interested in, given inflation, etc., is infrastructure. So globally, everybody's looking at infrastructure assets. And the Adani Group is obviously very exposed to the infrastructure sector, which is a very important sector of the Indian economy. So if this group goes under, then it impacts the whole infrastructure development to some extent. So that is a concern. The second one is obviously, there are emerging worries about India's corporate governance, perhaps governance at all levels. And, and then should India really trade at the premium that it does, given some of these governance issues? Having gone through some of these issues in China and some of the other countries, there is that lurking fear that this could have that there is a lot else. It's not the only group. There are other things that are being hidden that might come out later.
That's right. You've hit the nail on the head. Those are exactly the kind of concerns which people have been talking about today. But Mr. Singh, you've been an old hat at all of this. You've observed all of this over the years. How do you think this episode will end, and what kind of a damage will it finally exact on India?
Well, I do not know. I am not in the too much familiar with what's going on. I think we had some very expert voices commenting on this. But I do hope that two things. One, that the contagion effect, as was being pointed out, is negligible. And I would certainly hope so, that there are no serious issues of regulatory failures, because then, of course, we have a very robust legal system. And if there are issues, then I have no doubt that the rule of the law will prevail. But I hope that there is no serious contagion effect. Beyond that, I have no particular information on this episode, how it began and so on and so forth.
Okay, we'll come back and talk to you about the budget in a minute, but I want to get Dinesh Kanabar into this discussion. Dinesh, quick word from you on the other thing which created some confusion in the market in the budget, because when the announcement was made about the income tax reliefs and the slab changes, etc., everybody got very excited. But later on, when we asked people whether they would move from the old regime to the new regime because of these changes, many of them said no, we've got existing plans in place like housing loans and insurance, etc., and it probably doesn't make sense to move to the new regime. How much relief has actually come in, and how much will it be actually utilized by the middle class, you think?
So if you look at the corporate regimes, two regimes, almost 80% plus of the corporates have moved from the old regime of deductions and exemptions to the new regime. Unlike that, in the case of individuals, not more than maybe 10% have moved from the old regime to the new regime, just given the attractiveness of whatever were the deductions which are available. Now, it of course, it will depend from individual to individual as to whether somebody has taken a housing loan, whatever else. But clearly the emphasis of the government seems to be that all the concessions going forward will be available only to the new tax regime. So whether it is increasing the exemption limit to the reduction of the rates of tax to the highest peak rate going down from 43% to 39%, all of those benefits have been provided only to the new tax regime. So I can say, for example, HNIs are very, very likely to move to the new tax regime. For others, it will depend on case to case, and I think it will still take a couple of years before we see a significant shift of people moving from the current tax regime to the new tax regime.
What's your best guess right now, Dinesh, of how many people in the middle class, in the 7 lakh to 15 lakh category, who would make that shift today, given the incentives on offer?
I would think it would be an even split right down the middle. There will be people who are just paying their taxes and who will find that availability of higher disposable income to be very attractive. Now they don't have to put money into insurance just because there is a tax benefit available, etc., etc. So they will want to move. Those who have got housing loans and things like that will refuse to move.
Mr. Singh, did the budget numbers appear credible to you? Because we've had a former budget maker, Subhash Chandra Garg, just tell us that to him, the capex numbers look slightly suspect because much of it is substitution. In any case, some of it is going to oil marketing companies, some of it is going to BSNL, etc. And therefore, despite that 10 lakh crores of capex outlay number, the actual implementation numbers would not be that spectacular. Would you agree with that assertion?
Well, I do not think that prima facie I find the numbers to be of any serious worry. By the way, at 10 lakh, you must add to it an additional 1.3 lakh crore more, because at the end of the day, the 1.3 lakh crore given to states is also for capex expenditure. So if you add these two, it's really more than 10 lakh crore. The Finance Secretary today was clearly, in response to a question in the press interview with the Finance Minister, was very sanguine that 97% is already done, and he is quite sanguine that by the end of the financial year, this expenditure would fully match up to the allocations which have been made on the capex front. And I don't think that, very frankly, there could have been a better use, that if you are going to have the public sector borrowing program, there was any other type of expenditure which will merit this kind of a substitution between what has been preferred. I think in that sense, it has been a very good balancing between the revenue and the capital expenditure. It has been a number of years, 9 years when I was in the Ministry of Finance, this was one of the things at the end that one always felt of how to get a better balance from on the capital expenditure side. And I'm really delighted that this has shown positive outcomes and it's begun to happen in a very credible way. One thing more I will point out is that, and this relates to Udayan, to the states, if I might, that I'm a bit disappointed that notwithstanding the additional fiscal space which Chairman of the Finance Commission we had given to the states, both in terms of higher borrowing over and above the 3% FRBM limit, and also the additional capex resources which were made available last year. This year, again, 1.3 lakh crore has been given. I hope that the absorptive capacity of the states really match up to these kinds of additional allocation and fiscal space which is available, because it will be quite sad if the unutilized fiscal space is used by the central government and helping them to achieve the kind of fiscal consolidation targets which has been outlined in the FM's budget speech. The last question, which I would like to take this opportunity to, if I may say so, I really believe that on taxes, the tax buoyancy, which you know has been assumed to be only 1%. I think that with improvement in the GST numbers and also in the improvement in some of the structure of the GST itself, we are still about 3 to 4% away from the revenue neutral rate in the GST. If that were to make some progress, I think that the borrowing requirements of the public sector would shrink dramatically, And that would have a lot of multiplier effects in terms of creating even greater space for the borrowing requirements of the private sector. So I think there are many things. If anything, if I may say so, this budget estimates have been a conservative one. And I must compliment really the budget makers and the finance minister that they have opted for caution instead of being over exuberant. And I think these numbers, in my view, I don't agree with Subhash, are quite realistic.
Okay, fair enough. Dinesh, the one sector which seems to be quite disappointed with this budget is the insurance sector. What did you make of the changes there, and in your opinion, were they harsh?
So, two things which have impacted the insurance sector there. One is the thrust of the government to move from the old tax regime to the new tax regime, and therefore insurance deduction, insurance premium deduction be not available. How much will that impact? And you asked a very pertinent question earlier, Udayan, as to how many people will move. That remains to be seen, but it certainly will have some impact out there. But the more important thing, and again estimates vary out there, that a huge predominant portion of what the insurance companies are selling is really a savings and insurance plans. It has less to do with insurance and more to do with savings and returns on those savings. I've heard some wild numbers that no more than 7 to 10% of the insurance policies which are sold have to do with life insurance, and more has to do with really a return on whatever is put up out there. And therefore, when you come back and say that if you pay a premium of more than 5 lakh per annum, then any return on that is not something which is tax exempt, is something on which tax is payable unless the money is of course paid to the deceased. That puts a very, very big dampener. Of course, the provisions are effective from 1st April next, so it does not apply to the policies which have already been sold in the past. But clearly the ability of insurance companies to sell new policies, to make money on it, is going to be very significantly impacted. It will now be viewed as a taxable return class as opposed to a tax-free return class.
Okay. Punita, which way is the global wind blowing now? Because, you know, in India we have a very high current account deficit. It may ease off in the quarters to come, but the last print was quite high. And the rupee has not been the best performing currency over the last few months, has done far worse than many of its emerging market peers. So when you look at India and you look at the macro balance of India, which way is the wind blowing as far as foreign investors are concerned, at a time when interest rates may stay elevated for pretty much the whole of 2023?
Right. I mean, I think the world is grappling with a number of different things. Geopolitics, which we haven't discussed, obviously, not on this channel, but that's a big worry, and that's really impacting the future trend of commodity prices, oil, which India is a big importer of. A lot of our companies are importing a lot of raw materials. So to the extent that these raw material prices firm up further, then that could impact our margins. So that's something that one has to study company by company. But if commodity prices ease, which they've done recently, then that would be a positive trigger. In the US, inflation is still painful, and it's very hard to find workers. And there's a real shortage of people. And now, of course, the job market has also begun to soften, and there are layoffs happening. So there is going to be pressure on earnings in the US and in some of the developed markets. And that would mean that either investors go more into fixed income instruments where they're getting pretty good yield, or they also start reallocating to other markets, emerging markets, which haven't performed, and where there is more, labor slack. Now, for instance, one of the trends we've seen is increasing outsourcing to India. So the job market in India could tighten in terms of finding people. As it is, we are seeing very high attrition levels in India because we just don't have the skills. And this budget has really focused on improving skill development. At least they've talked about it. Whether it'll be easy to execute or not, it's a different story. But at least they've recognized that need of capacity building in training, education, nursing, and many, many other areas where there is we are very short of trained people. So the world is not at a happy place right now in terms of a number of reasons. As I said, the macro is a little painful. FOMC will tell us how they see the macro. But the way I'm seeing it is that we're not going to have a big recession. It's going to be, a shallow one. Perhaps the inflation has begun to ease a little bit, and maybe the rate hikes won't be as drastic as they were last year. But will they start coming off? That depends a little bit on what happens in geopolitics. And all of that will have an impact on flows, on global investor sentiment, which asset classes they choose. One of the reasons you've seen gold prices go up is because of those reasons. And if flows to emerging markets in India increase, perhaps the rupee might arrest the trend of depreciating.
Okay. Mr. Singh, Punita spoke about the unemployment issue, and in the US, they look at that number so closely, and it's one of the most important facts that they consider while examining their macro scorecard. But in India, we don't speak so much about the unemployment issue. Do you think this budget, which keeps talking about 4, 5 years and 10-year visions, is doing adequately to address India's looming unemployment issue?
Well, I think that very frankly, 3 points. I think this is an important point which you have raised. First of all, I think part of the reason, apart from the issue of data and the credibility of data, I heard several TV programs in the morning on your channel itself, where there was a debate, and on other TV channels on the quality of the data on employment and their credibility and so on and so forth. That's one aspect. The second aspect, of course, is the nature of the economy itself. The unemployment in the informal sector is somewhat difficult to gauge, much more difficult, in my view, to address in a meaningful way. But I think that the path forward is some of the key ingredients in relation to that have been touched in this budget in a decisive way. One is on skills, skill inculcation. There's a mention of the apprenticeship program, which is something which would be absolutely in the right direction, along with the fact that the use of technology in multiple ways, the digital issue, will enable a much faster adaptation of skills and realignment of pedagogy for the creation of skills necessary for the jobs not only present, but the jobs which are the jobs evolving and the jobs which are ahead. So I think that the issue of jobs is central in my view.
Okay, Mr. Singh, we'll have to leave it there, but thank you very much for joining in today. We will slip into a break right now. When we come back, there are many more experts joining in to talk about not just the budget, but the looming FOMC meeting ahead of us, the rout in the Adani Group stocks, all of which went into the pot today to make it a really absorbing session for the financial markets and overall an action-packed day in the world of business. Back with more of that.
Unmatched. Udayan on your side. Budget 2023 with India's #1 budget team.
It's 2023, and India remains the sole shining star in the global economy. So what lies ahead as the Modi government prepares its last full budget before the 2024 general elections? Join the biggest names in business journalism, decoding the jargon with the biggest newsmakers. From the most credible, in-depth analysis of Budget 2023, tune in for Modinomics 2023 through the month. Only on India Today and Business Today Television, gold standard of business journalism.
The only budget coverage worth your time. Blazing fast actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team. Only on India Today. The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team.
It's 2023, and India remains the sole shining star in the global economy. So what lies ahead as the Modi government prepares its last full budget before the 2024 general elections? Join the biggest names in business journalism, decoding the jargon with the biggest newsmakers. From the most credible, in-depth analysis of Budget 2023, tune in for Modinomics 2023 through the month. Only on India Today and Business Today Television, gold standard of business journalism.
The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team. Only on India Today. The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team.
Today and India Today special evening coverage of the budget. It's been an action-packed day for the world of business. It was not just budget day, it was another day of bloodbath for Adani Group stocks, and that story is just not going away. Later this evening, we'll hear from the FOMC, and that will set the stage for what happens globally with interest rates, and that may go on to be an even more important event than our own union budget. So today is really, as things go, a really action-packed day for the world of business. And to talk about all of that, I've got Naina Kidwai from Rothschild and Company. I've got Vinayak Chatterjee. I've got Haseeb Drabu. In a bit, Nilesh Shah will also join me. Ladies and gentlemen, thank you very much for joining in. Naina, straight off to you. Before the budget, I want to ask you about this continuing saga of the Adani Group, and if that is roiling sentiment towards India in the eyes of global investors. No better person than you to tell us that.
I have to say that, it is very unfortunate to see this development, and it does impact our stock markets. Investors will continue to watch and wait. They're used to seeing, these sort of events that hit particular investments or stocks. They will wait for clarification, and many have a longer term view than just selling on a bit of bad news. Many have done research and indeed looked at the companies in the group before investing. And as you well know, even the FPO saw a number of high quality sovereign wealth funds and others come in. So we should wait and see. But yes, the impact on our domestic market is really quite unfortunate. And I do hope that everything clears up in due course. It just goes to show how volatile these times are. One piece of news and it can absolutely roil the markets.
Vinayak, it pertains to the sector that you observe very closely. I mean, we've spoken about the stocks, the impact it may have on banks, but such large projects, airports, ports, I mean, these key infrastructure projects, I mean, in a way, can it come in the way of executing those projects or continuing with those projects and set back our infrastructure growth story in any meaningful way, in your eyes?
I don't think so. I think this brouhaha will go away soon, because I honestly don't know much about stock markets or capital markets, because that's not a sector I have focused on. But I do understand deeply the operations of core infrastructure sector, and my view on Adani is very simple. Today, there are a bunch of operating assets which are stable, which are unaffected by global ups and downs of foreign trade, or ships are coming and going from the ports, aircraft are landing, power is being generated and sold, and cash is being collected. Cement is being produced and sold, and money is being collected. So today you've got a bunch of well-established projects, infrastructure, core infrastructure, and infrastructure intermediates, which are in a stable state, generation and collection market. That's the existing portfolio. Then you've got Adani investments in a bunch of projects which are under development. There are the Viringram Port project, the Tajpur project in Bengal. There is a very large 15,000 megawatt project in Kutch, in Khavda, which is the world's largest renewable energy project. These are projects which are under development, for which capital has been tied up, and the projects are under execution, including the expansion of many airports, expansion of ports. And the value of these will unfold as soon as the implementation phase is over. When you combine both of these together, as a watcher of infrastructure, I don't see any problem in these projects running and delivering. And therefore, the class of investors coming to capital markets now, the class of investors that understand infrastructure finance and understand the long gestation periods of what it takes 3 to 4 years to develop a project. You can't buy and sell a share in 3 months. This is not that kind of stock. It is a value long-term stock where projects which have intrinsic assured demand are there for the next 100 years. So people who are in the business of long-term investing in infrastructure, I don't think see a problem.
Vinayak, let me just interrupt you, because all that you say is very relevant and pertinent, except that one heard all these things with a group called the Anil Ambani Group. He had power projects, he had infrastructure projects, he had metro rail projects, and you know how that story ended.
But I have to tell you that most of the NPAs that have occurred in infrastructure projects in the past, not so many now, are because of deficiencies in government and public policy. When Mr. Gadkari took over the Roads and Highways Ministry in 2014, one of the first statements he made was that 90% of road NPAs were because of problems of the government, of land acquisition, utility removal, etc., etc. So please remember that across Indian infrastructure groups, private capital has been largely let down by deficiencies and inefficiencies in government policies, whether it is the bankrupt discoms not buying power, whether it is gas not being available and power plants have been set up, or where land acquisition for roads have not been done. If you take now, since you're talking about Anil Ambani, let me tell you very clearly, right up to the Supreme Court, he has won an arbitration for some 4,000 crores to get from Delhi Metro system. That cash doesn't seem to be coming. So cash doesn't flow in from the system, governmental systems for infrastructure projects set up with public money because of deficiencies in public policy. And then you blame the investors who have responded to prime ministerial calls in the past from different prime ministers to show animal spirits and invest in the Indian infrastructure story. So we have a real dichotomy here of saying that will somebody please examine the deficiencies of public policy that have led to the vast NPAs that you are now referring to. But I rest my case.
Okay, fine. Naina, let's talk about the other event which is coming up today before we talk about the budget, the FOMC. A lot of people believe that's a far more important guiding factor in how economies and business prospects shape up over the next few months. Do you agree with that, that if interest rates remain higher through the year or high through the year, then that is a big headwind to be swimming against for all countries, including India?
So the whole question really is, where are we on this interest rate cycle as the world goes? And there is an expectation that there's a small amount of increase still awaited. And there's no doubt that with the interest rate increases, it sucks liquidity out of the system, and that in itself brings, other concomitant issues into those economies. Now, India, fortunately, is not deeply affected. Of course, we're affected. We're affected where if these interest rate hikes are too sudden and too high for those countries. We see Europe's already in recession. There's talk of the US going into only a very light recession. But these impact our exports. They impact us in terms of our offshore borrowing costs, at least for corporates. And but the impact is really there only at the edges. So the bigger headwind for us is the volatility that could come from energy prices, because the Ukraine-Russia war is still not over, and the volatility therein, which we saw last year with the doubling of our oil import bill, are still worries that could hit us the way they did out of the blue last year. So I would worry more about these very particular and peculiar to India issues, the fact that we are so dependent on imports of fossil fuel and that vulnerability, for example, rather than the FOMC, which does impact us at the edges, but not hugely. I think the one to look at is where are we in terms of our own RBI and that interest rate hike. And there's general speculation on the street that maybe another 25 points is about all we might see, but maybe not even that. So we may be at the top of our interest rate cycle here, because inflation in India is well under check, which of course is not necessarily the case in all countries around the world. So I think we are driven much more by our domestic situation than global, but that is not to say that we can ignore what's happening globally, particularly on oil. And oil prices worry me because China comes back now with a bang post-COVID as it opens up. It's, as you know, a very vibrant economy. And does that begin to push commodity prices up? Does that begin to push oil prices up as we compete for the same resources? And that effect on us is one of the volatilities I would worry about.
Okay. Haseeb, Drabu has also joined in. Haseeb, 1 year to go before election, a lot of people worry that a budget could have been populist. But there were no great signs of populism as such. I mean, no great plethora of social schemes, etc. The government seems to be keeping its eye on investment and capex like it has over the last couple of years. Did that pleasantly surprise you?
Yes, in fact, more than that, because whatever freebies have been announced, like this, underwriting the consumption of the poor, are well designed and do impact the overall macro strategy underlying the budget. Because what you're trying to do by underwriting consumption of the poor, you are increasing disposable incomes, and you're doing a similar thing for the middle class as well because of the tax rebates, and also undertaking capital expenditure to generate demand. So even though there is some freebies are there, which, I mean, budget at the end of the day is a political document and you have to face the realities of an election, the fact remains that whatever freebies are have a certain economic logic in the context in which we are operating. So we are trying to rely on home market demand more than the external demand, because in face of an impending recession happening globally, this seems to be a wise way of managing the expenditure allocations within the budget.
Okay. Vinayak, the real excitement in the budget for a lot of people was that jump in the capex outlay from 7.5 to 10 lakh crores. But Subhash Chandra Garg was just telling me that, if you look at it closely, many thousands of crores out of that additional 2.5 lakh crores is actually money going into BPCL or the OMCs, going into BSNL, and actually a large part of it is substituting the funds which could have been raised from the market by government institutions like NHAI and IRFC, who are unable to access capital from the market, and therefore government is putting equity in them. So do you see 2.5 lakh crores of additional stimulus on the capex front, or do you think the numbers are actually not as much as the headline would suggest?
No. I think the numbers are as exciting as the headlines suggest. I greatly admire the consistency of this government year after year in using infrastructure spends as the pump primer of economic growth. In fact, very clearly last year after the budget discussions on a similar TV panel, I heard one of the chief bureaucratic mandarins of the finance ministry give me a very interesting statistic, which had been confidentially, shall we say, doing the rounds in the finance ministry, that 1 rupee spent in direct benefit transfer results in 0.9 rupees or 90 paisa of GDP, whereas 1 rupee spent in public works or infrastructure results in 3 rupees of GDP. So if this is the governing mantra, the government has been very consistent. So far as the point you made about Mr. Subhash Garg, I am completely confused, so I don't want to comment on it, except that every year such similar things happen where monies come in from privatization or is made available to PSUs. It happens every year. So if it happens every year, then you're comparing apples to apples, and I'm comparing 7.5 lakhs to 10 lakh crores, which is a whopping 33% increase over the 35% increase last year with remarkable consistency. I also like the change in focus. If you've seen this budget, it very interestingly shifts focus from road to railways. In fact, I just noticed that this is the first finance minister's speech in 20 years that does not have the word roads in the budget speech. And it has a special emphasis on railways. So as a nation, we recognize the fact that roads, after a quarter century of development, have reached a level of maturity which is a carry-on business of building roads. Whereas railways is the new focus area. Urban infrastructure is the new focus area. So I think the broad numbers are well within the direction that national goals suggest, including the emphasis on urban infrastructure, on green energy, etc., etc. So I'm pretty happy with the logic, the structure, and the way infrastructure spends have been allocated. Over to you.
Naina, yet the problem remains that private sector capex has not been drawn in to the extent that the government would have wanted. I mean, year after year we hear the same thing, that there are some green shoots, but private sector capex is still not kicking in with the same enthusiasm that the government is going about its capex business. Why is that the case, and when do you see a change in that?
I think the economic survey uses a great word, incipient private sector investment. So obviously there are some green shoots emerging there, which is good. And in fact, a FICCI survey of 110 CEOs suggested that many were up at the sort of 70% capacity utilization, and about 25% were actually going to look at investing further this coming year, which is refreshing, frankly. So as I think what you see here is the government can't push the private sector, it can only cajole. Many companies have come out of COVID quite shaken, still writing down debt and looking at the MSME sectors. We are seeing, I think, a recovery evident from the credit growth, which was reported from Jan to November at a 30% increase, which suggests that MSMEs are, in fact, healthy enough to receive money from the banks, and also that the banks are opening their purse strings to MSMEs. So with MSMEs coming back into play, with the kind of confidence which is returning into companies, I think private sector investment goes up. But I do believe it is in recognition of the fact that this is not happening in a hurry. That government is saying, hey, we're going to step in, we're going to spend the money, make sure that we're providing that impetus to growth, giving the private sector a chance to step in. And for every penny, to Vinayak's point, and who better than him to tell us this, that for every penny that is going into infrastructure, logistics costs come down. And as logistics costs come down, our somewhat more expensive logistic costs vis-a-vis other countries helps the private sector to compete, to export, to bring prices down, to move goods faster, and that multiplier effect is huge. So I think it's really more a sequencing. In looking at private sector investment, you have to also include foreign direct investment now. We are seeing, I think, very exciting development with the way Apple has embraced India, $1 billion in December, bringing with them their own supply chain, some Chinese, some otherwise, to set up shop in India. And it is exactly this sort of trend that we need, where manufacture in India by companies which are really very, very quality focused. And they're doing this for the Indian market, they're doing this for export. So what we're producing in the country has to compete, has to have absolutely that top quality. And indeed, I do believe we're passing the test. So we will see more of this. Companies that have watched the Apple experience but will jump in. And the budget, by the way, talks about electricals, electrical goods, electronics, and diamonds, and some of the focus in these sort of markets and products.
Nilesh Shah of Kotak Mahindra AMC is also with me. Let me toss to him. Nilesh, thanks for joining in. You know, I've been asking everybody this question, that this is a budget which on another day might have seen even a 1,000-point rally on the Sensex, but it ended up as a damn squib because of this Adani episode. Has it got to that point where even long-term investors are getting a little worried about the situation? Because local investors have held this market up over the last 1 year in the absence of FIIs. Could that begin to change if this issue worsens further?
So then, as you know, in investments, there are multiple headwinds and crosswinds. Now, for example, I don't think so till 3:30 market realized that there is an opening in GIFT City, whereby if you invest via P-notes issued from GIFT City, there will be zero capital gains tax. I'm sure tomorrow FPIs will have a look at it, and once they realize that their returns could go up by 10 to 15%, maybe their views and opinion will change. Number two, today, excluding the tax benefits proposed in this budget, we have seen active foreign investors selling India to move into cheaper markets like China, Hong Kong, and that's why they are up in last 30-40 days. We were trading at a premium valuation, and hence, despite such a good budget, probably markets have corrected. But what is surprising to me is the numbers which I was looking today. Institutional investors, both local and foreign, were buyers. So it is not necessarily FPI selling, it might be speculative selling, who knows?
It could be, Nilesh, but there is no getting away from the fact that domestic sentiment has been hurt over the last few days because of this Adani episode. I don't know who was selling, but you cannot get away from the fact that such an important group has lost 30, 40, 50% of its market cap, and it has no impact on domestic sentiment at all. Surely you are not suggesting that.
Undoubtedly, no. The sentiment is fickle, it changes with events. What is important is fundamental. And this budget has ensured that Indian fundamentals are put in right place. It has laid foundation in terms of increasing infrastructure allocation. It has tried to provide some support to the bottom end consumption, and it has also given a path of fiscal prudence. So within the limitation, within the constraints, this budget has continued to do the good work, and hopefully it will help in improving fundamentals and eventually sentiment.
No, it could have done even more, the budget. It's a good budget, but had she had more resources to play with, she could have done more on investment, more on capex, more even on stoking consumption, and maybe even bringing down the fiscal deficit. But the government is unable to do that because it's not getting money or enough money from asset monetization or disinvestments. Where has that story got derailed, Nilesh, in your eyes? Because we are setting up these very tepid kind of targets, not even able to meet that in reasonably good market conditions. What has gone wrong?
I think there are vested interests which are opposing asset monetization or divestment. For example, I have been saying for so long that there is more than 9,000 properties in custodian of enemy property. Both India and Pakistan implemented this in the late 60s. Pakistan liquidated all enemy properties by 1971. We are 50 years behind Pakistan in liquidating 9,000 properties of India. I don't know why it can't be liquidated. These are real estates. Over a period of time, they will be encroached upon. We must use the law of the land to clear the encroachments and monetize those properties. We have seen how public-private partnership turns around the fortune of a company. Air India was loss-making entity when it was run by government. I believe, based on today's newspaper, it may report operating profit this year. Within 1 year, there is a dramatic turnaround. Hindustan Zinc was a loss-making PSU producing 100,000 tons of zinc in 2003. Today, it produces 1.8 million tons of zinc, giving 10,000 crore by way of contribution to government kitty. So economic rationale for divestment is there, but I don't know why it doesn't get operational on ground.
I know we are all very mystified about it. Somebody suggested it's a bureaucracy which is opposed to it and doesn't want to let go of state assets, and therefore these vested interests are coming in the way. Whatever it is, it's not happening. But ladies and gentlemen, thank you very much for your time on a busy day. I'll take a quick break and come back with two other experts, Sanjeev Bajaj on the budget, and I'll also get Nikhil Kamath of Zerodha to talk about all the events which affected the financial markets today. Back in a minute with all of that.
The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched, Udayan on your side. Budget 2023 with India's #1 budget team.
It's 2023, and India remains the sole shining star in the global economy. So what lies ahead as the Modi government prepares its last full budget before the 2024 general elections? Join the biggest names in business journalism, decoding the jargon with the biggest newsmakers. From the most credible, in-depth analysis of Budget 2023, tune in for Modinomics 2023 through the month. Only on India Today and Business Today Television, gold standard of business journalism.
The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team. Only on India Today. The only budget coverage worth your time. Blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team.
It's 2023, and India remains the sole shining star in the global economy. So what lies ahead as the Modi government prepares its last full budget before the 2024 general elections? Join the biggest names in business journalism, decoding the jargon with the biggest newsmakers. From the most credible, in-depth analysis of Budget 2023, tune in for Modinomics 2023 through the month. Only on India Today and Business Today Television, gold standard of business journalism.
The only budget coverage worth...
Still watching Business Today and India Today's coverage of the budget, and it's been such an engaging session for business observers. All that has happened through the day, a good budget, the Adani chaos, and then now later tonight we are heading into the FOMC meeting. It's been such an engrossing session. I have with me now the CII President Sanjeev Bajaj to talk about the budget, and in a few minutes I'll be joined by Nikhil Kamath, that's once we are through with Sanjeev, Nikhil Kamath of Zerodha to talk about the other issues which affected the market as well today, along with the budget proposals. Sanjeev, thank you for joining in. My first question to you is something which all the guests in the show have been talking about, that the government is continuing with its relentless thrust on on capex. 7.5 lakh crores went up to 10 lakh crores today. So when is private sector going to participate in the way or to the extent that the government wants it to participate? When do you see private capex taking off in as big a way as the government capex has been?
Well, then the comforting fact is from the economic survey yesterday, which talks about the revival period for the economy now being complete and we starting to go back to normal growth. Normal growth is just under 7% this year, expected to be between 6 and 6.8% next year. So in a situation like this, as long as demand stays constant, I believe in multiple sectors, we have reached the levels of capacity utilization where you will start seeing new investment. We are starting to see some early movers here, whether it's in sectors to do with construction, steel, whether it's sectors like chemicals, and we expect to see more. It is encouraging to see that the government continues its investment in public sector capex. Again, a big, as you said, a big jump to 10 lakh crore this year. It was a key CI recommendation as well, because this has a multiplier effect on the economy. Not only are we creating new assets, we are creating new jobs, we're putting more money into people's pockets so that they can go and consume, which should get the private sector capex cycle going. So I would say that towards the later part of the new year, you should start seeing some announcements. We know that a number of board discussions are going on to increase capex, and as long as the external environment stays relatively steady, you should be able to hear many more announcements.
You mentioned the reasons why people are getting drawn in now slowly, coming to the table with the improvements in capacity utilization. But if I may ask you, what has been holding back CEOs so far? Because bankers that we speak to, they say that we have started a credit cycle, but it doesn't seem to have that confidence that we saw in the boom years of 2004 to 2007. What to your mind is holding people back, CEOs back from doing big ticket investments?
Two very clear things. One is consistency of demand, and the second is uncertainty. And in this case, we know, unfortunately, the uncertainty ends up being mostly global. And that's why I prefaced it by saying that we hope that on the global side, the uncertainty reduces. The war is still on. We don't know when that will end. But the shutdown of China has reversed. And I believe in another couple of quarters, you will start seeing significant growth coming to the global economy because of China opening up, because of revenge buying after years of staying locked. So those are all positive tailwinds to current economic situation. And with the continued investment in public sector capex as well, you should see consistency of demand on the ground. That is what private sector needs, because eventually the private sector capex that goes in requires a certain minimal return. And that's where we are right now.
Both from a CII perspective and from wearing your hat at Bajaj Finance, give us a consumer perspective, because there have been some concessions on taxation slabs today, but a lot of experts seem to believe that's not enough for people to move from the old regime to the new regime, which is a failure from the previous year. I mean, incentives were given, but most people chose not, for various reasons, not to move to the new tax regime. What will the experience be to your mind this year? Because on it hinges the fact on whether we'll get a consumption boost from what she announced in the budget today.
So two different things over here to give that consumption boost. One is I was talking to my friends who are tax experts, and what they believe is the lower income segments right up to the middle class are likely to move to the new regime because it ends up being beneficial. And above a particular cutoff of maybe 5 crore of income, you will again see people moving to the new regime because it ends up being beneficial to them. So that's one set of data points. But the second more important thing is people end up spending money, they end up buying when they are a lot more confident about the future. And that's where this budget, in continuation of previous years, continues to create that level of confidence across so many different areas. If you very simplistically look at this budget, it is as much about perform for today as it is about transforming for tomorrow. So the perform for today comes because of cutting the income tax, putting more money in people's pockets, the investment on the capex side, which immediately creates additional jobs, new money on the ground. But it's also about transform for tomorrow. The effort to completely digitize agriculture, improve efficiency and productivity, the additional effort on skilling and to upgrade education so that we are teaching what is relevant for tomorrow. I would say healthcare, 157 new nursing colleges, which will create new jobs and high quality healthcare professionals. The seeds for tomorrow are also being set, and that creates confidence. And when you have confidence, then people end up spending money.
Now I want you to wear your Bajaj Alliance hat for a bit, or Bajaj Finserv hat for a bit, and tell us about the setback in insurance as a sector today, because all those stocks were down and people had glum faces in that sector.
So insurance has to really try and assess to see what's the level of hit that they would end up taking because of this tax benefit going away. And that's only on those policies where the premium, as you know, is in excess of rupees 5 lakh a year. So we are talking about it at the higher end. So clearly at the higher end where these policies were being bought as a savings tool, that gets hit. On the other hand, as the government says that we are moving away from subsidies, from exemptions, we are going to lower rates. So that's the flip side of it. And this is perhaps one of the short-term casualties over there. But we have to keep in mind that the larger number of insurance policies are bought by the middle class and they don't get impacted. So as I said, I don't have the exact number right now. It will have some impact, but markets can end up overreacting in the short term.
The one issue where there is constant disappointment in what has otherwise been a solid budget, which everybody agrees is the area of asset monetization and divestment, where the government, everybody says that if she could get 1.5 lakh crores from that area, so much more could have been done. Where are we getting stuck with that, Sanjeev?
So I believe that, I think the number is just north of 60,000 crores. So in a way it's being realistic, keeping in mind what has happened this year as well, about 40,000 crores or so far. So it's not a pie in the sky number. It's a number which takes into account, I guess, amongst other things, the fact that we will go into elections next year. But at 60,000 crores, I would say that while not as high as what one would expect, it is perhaps at least a realistic number.
What about the issue of employment? Because that's a central issue facing India now, not oft discussed. There has been some talk about skilling, but do you think the budgets of the last couple of years, this included, is actually addressing that problem in a frontal way, creating the kind of solution that neighbors like Vietnam and Bangladesh have been able to do with lower end manufacturing to resolve this issue? Or do you think more needs to be done here?
Well, a lot has been done at the center, even with the 4 new labor codes, measures announced on skilling today, the new sets of jobs that comes from all the spending that's happening at the center. What we have to see now is states chipping in as well, the private sector chipping in as well, so that together we convert these into actions and execute against them and thereby creating not only new jobs, but a vibrant workforce that is skilled in the right manner for these jobs as well.
Do you think we are on course to get to 4.5% fiscal deficit in 2 years? Or, I mean, starting the clock at just below 6%, it seems too lofty an objective. We'll not get there.
Well, the future can have many ups and downs, but I'm encouraged by the fact that they are meeting this year's deficit and versus next year, where CII we were expecting a number of about 6%. The fact that the finance minister has talked of 5.9% is also encouraging. We are still in a very volatile world, but as we move forward into the next year, it will give us a greater sense as to the realistic chances of hitting 4.5%, which is what the finance minister has committed to at this point of time.
Sanjeev, thank you very much for joining in on a busy day. Appreciate your time. Thank you.
Thank you.
That's Sanjeev Bajaj, President of CII. And now we move to the final speaker on this show. There's lots coming up at 8 o'clock and 9 o'clock with Rahul and Rajdeep. But my final guest on the show today is Nikhil Kamath, founder and CEO of Zerodha and True Beacon. Nikhil, good to see you again. As I was telling everybody, the budget was good maybe, but it got overshadowed by events in the afternoon. I mean, where is this Adani episode heading in your eyes? Because it's created so much uncertainty, confusion, even panic in the minds of investors.
Hi, Udayan. Yeah, so today felt like, there's an India-Pakistan game on and India was actually winning, but TV kept replaying a Ranji Trophy game, which didn't matter as much, Budget almost became the secondary event of the day. Very hard to call, Udayan, with Adani stocks. The one thing I would say, though, I think we need to consider someone not guilty unless proven otherwise. And, Hindenburg, the hedge fund, is not doing this from the goodness of their heart to inform people better, but they have a short position on the stock.
Of course.
So, whatever they say, I think I would take it with a certain amount of caution because they are bound to be biased when they profit on the downside of Adani.
That is, and they have not hidden that position. It's publicly disclosed. So there is no cloak and dagger situation out there. But do you think a position taken by one investor can roil a group of this size so badly? I mean, it's like saying somebody picked a stock and the stock doubled overnight, a very, very influential group. Or is there some smoke behind this fire, or some fire behind this smoke? Otherwise, the market may not have reacted consistently for so many days like it has.
I think one will have to really research all of the Adani companies together to get to the bottom of it. But I personally have not put in that amount of work. But yeah, it does look unnerving to see stocks this large fall 20-30%. And whatever the resolution is, I think this volatility is bad for investors. A retail guy buying, subscribing to the FP, all of that. I don't think these moves up 20-30% or down 20-30% in either direction help many people. So I hope there is some kind of clarity which comes out of all this in either direction.
The year has not started well for India, Nikhil, and we were talking at an event and you were making the point that we are expensive relative to our peers and maybe some underperformance lies ahead, and January has been an underperforming month. Do you expect this year to be similarly volatile for domestic investors?
I would think so, even considering, notwithstanding the correction we have seen up until now, which has been, about 10%. On a relative basis, we are still more expensive to where we have been in our own past. But more importantly, I think we are more expensive than many other geographies across the world. So one wouldn't be hard pressed in, if they had to call this side or that. I would pick the side that, markets will probably bring in a little more turmoil this year than a usual year by virtue of the frothy territory we sit on today.
And what are your expectations from the FOMC meet, and how crucial would that be in shaping market course for markets like India in the weeks and months to come?
So in many ways, we're at the mercy of the FOMC. I think when they increase rates, we invariably have to increase rates for many reasons, but also to protect our currency. It looks like they're slowing down. We'll have to watch the events tonight, but even if they slow down and they continue to increase rates, cost of capital, which has already run up so much, there has to come that point where that line is crossed, where people realize that putting money in debt and not taking the risk might be a better thing to do in the next 2 or 3 years. I don't know what that level will be, but I hope we're a certain distance away from it. But yeah, it will detrimentally affect us for sure.
Last 2 or 3 years, as you know better than most people, a lot of new investors have come into the market. Almost a new generation of investors have come into the market, new demat accounts, lots of SIPs. And this is the first real test for them. 1 year of practically no returns, and then a year which has started on a really volatile note. Do you think they will hold up?
If account opening activity or traction in the market is a leading indicator, it looks like a lot of people have really slowed down. Also, I think many people have incorrectly set expectations for themselves by virtue of what happened in the last couple of years. Let's assume Nifty long term does 10-11%. We had obscene returns in the last couple of years, because of the pandemic lull. I hope retail kind of readjusts their goalpost to target that 11% and not look for what happened in the near past to replicate in the future.
But do you see any sense of disenchantment creeping in, where people are either withdrawing SIPs or stopping SIPs, or high net worth individuals withdrawing from the market saying no, I don't think near term it can beat fixed income, that kind of sentiment creeping in at all?
Not yet, I think, Udayan. I think it will happen at some point, but I don't think the 10% correction warrants it. People are talking a lot more about fixed income, albeit because of the increased return that people are able to get. If you're buying AA or AA plus paper today, you're getting as high as 9%, and it's becoming increasingly attractive to many HNIs. But they haven't reach the level of disenchantment which would make them, reduce equity exposure drastically yet.
Let me ask you what you made of the budget yourself. I mean, did it alter or transform your view of the market or investing in any significant way, or your expectations of corporate earnings, which finally moves the needle for the market?
I don't think so. I think if you were to consider sentiment that was built up leading to the budget, from a capital market perspective, people were most worried about capital gains. We all thought that, when they say rationalization, will it mean the duration of short-term capital gain, long-term capital gain, or the rate gets tweaked? And most people assume that if it were to get tweaked, it would be on the upper side. And the fact that nothing happened, I think market took away as a positive. The one big thing that every equity investor and trader has really been asking for a long time is rationalization of security transaction tax. We all talk about how retail investors, many of them lose money when they're trading equity markets. One of the crucial pieces as to why they lose money is because the cost of transacting is still so high in India. And they didn't really touch on that. So I would say net non-event, but because they did not do anything to capital gain tax, I would say slightly positive.
And another question which keeps coming up, when I was talking to Sanjeev Bajaj about it just now, is why we are not able to make greater headway with asset sales, state asset sales, disinvestment, strategic sales. Why are we getting stuck?
Well, I guess it's a fairly complex thing. I think also by virtue of the factor of timing. I think even for the government at large, they need to figure out the timing of such an event. So I wouldn't know too much to comment on something like that, but maybe the timing is not in our favor right now.
What more would you have liked to see in this budget, Nikhil, other than the STT issue?
Well, I think they simplified, they didn't simplify, but at least they signaled that they're opening up in a certain way by reducing customs duty. I think that's a great thing. I don't think being protectionist is good for our country in the long run. Increasing the exemption limit up until 7 lakhs, I think it will put some money in the hands of consumers. Again, I don't know the quantum of that and how much money they will go out and actually spend, and consumer spending goes up. I don't know if that much change can warrant a really big end result. But most importantly, I think the problem we all kind of are aware of but don't talk about enough is India has 140 crore people, and 7 crore people file tax, and 1 crore people actually pay a reasonable amount of tax. I think for a country as large as India, if only 1 out of 140 crore people are paying direct taxes, I think something is wrong. And if something is wrong, maybe it's time to structurally change how we tax the country.
Nikhil, always a pleasure hearing your thoughts. Thank you very much for your time today.
Thank you, Udayan.
Well, that sort of wraps up the 6 to 8 p.m. special show on India Today and on Business Today TV. It's been eventful, but one must say at the end of it that it has been a budget which has not done any harm for any segment other than small tinkerings in insurance. So neutral to positive. I mean, maybe the headlines tomorrow will be rah-rah about capex and consumption boost, but we all know that the real implemented growth or achieved results will not be that good. But on the margin, it's more positive than that. So as the MasterCard ad says, more good than bad. And that's clearly what the union budget was. But tomorrow's another day, and we wake up to news on FOMC, and we wake up to news on whatever new developments happens on the Adani Group saga. So there is lots to look forward to as we wake up to the fine print of the budget tomorrow morning. But for today, that's all we have for you. And do stay tuned for a lot of action coming in, including some prominent ministers, both from the ruling dispensation and from the opposition, coming up with my colleagues Rahul and Rajdeep on the other side of this show. Thank you very much for watching.
blazing fast, actionable budget analysis. Budget intelligence that will dominate. Nirmala speaks, we decode in real time. Unrivaled, unmatched. Udayan on your side. Budget 2023 with India's #1 budget team.